Hello, it's James Willoughby, and I'm back for another update on what's going on in Austin real estate. Got a few weeks to catch up on here. Wanted to show you what's happening in the real estate world, specifically in the Austin market area. So let's jump right in. So here are our total active listings. As we would expect here, the last couple of weeks, we've seen inventory increase, and that's what I call the summer market about ready to happen. So we think summer is June, but in the real estate world, it probably starts a little bit sooner than that. But school's letting out here pretty soon, and we're on the edge of the summer market. So we are seeing some buildup of inventory, but that's not really bad news, because if we look at what's going on in terms of listings versus pendings, you can see right here that we're basically neck and neck as far as how many listings are coming on versus how many listings are going pending each week. It's kind of vacillates between one week. We have a few more listings that come on than we do pendings, and then it flip flops the next week. So that's not a bad thing. The good news is that if we go back all the way back up to here, it shows you what's happening each week. And I would say this last week was probably a little slower week because it was Mother's Day weekend and it rained on Saturday. So we had 973 new listings versus 933 that went pending last week. So that's what's keeping our inventory in check. As we scroll through these other graphs, we're seeing pretty much normal activity everywhere. The bottom line graph in all cases is weeks of inventory. That's really should say the absorption rate. So, last year this time we were way down here in the, under 5 weeks of total inventory, meaning that if every listing or if we didn't take on more listings, the listings that we had would be absorbed in less than 5 weeks. In fact, probably less than 4 weeks. Right now, we're hovering under 10 weeks of inventory, which is really kind of a healthy balance of supply and demand. So that's good for sellers and buyers. And then, interest rates, remember they went up. The short-term rate went up as announced by the Fed a couple of weeks ago. And you could see ever so slightly, but the mortgage rates actually responded positively to that information. And it goes back to what I've said in the past. If the Fed is controlling inflation by raising interest rates, the long-term players that are doing 30-year fixed mortgages feel confident that inflation is becoming more under control. And that's the case here as interest rates drop just ever so slightly in the last couple of weeks. The one thing that was interesting, we kind of hit a low here in February on our median sales price, and you can see that it's picked back up. So, because there's more of a demand, the good houses are actually causing the median price rather to go up, and the ones that aren't so great, they're just not selling at all. So anyway, that's good news for sellers, and it also should be news to buyers that they need to, consider buying right now. So we're tracking median price over time. We're tracking interest rates over time. The interest rate thing is, of course, always in the news. I think that we're going to see interest rates stay about the same throughout the rest of the summer, and I think they'll come down a little bit and be helpful in the fall and into the winter months. So, and that's helpful for, of course, buyers and sellers when that occurs here. Everything else, the numbers look in line with what we'd expect to see this time of the year. The thing right now is that we will probably see a couple of slow weeks coming up here when school lets out, people go on vacations and so forth. So be prepared for a little bit more inventory hitting the market versus what's going pending. but I don't think we'll see an out of control inventory situation. So that's the latest update on what's going on in the Austin market. Feel free to reach out to us and let us know if you have any questions. And we will talk to you next week. Thanks so much.